Hello, everybody. Mark here. And as you probably know, Tesla's down a lot today again, closing at $261.07. It dropped $6.36 on the day. That's a 2.3% or 2.38% drop over yesterday. And the stock is selling off after hours. And we'll talk about why in a couple seconds. So before we dive into the charts, let's go ahead and take a look at the only real relevant news for Tesla, and that is something that might have kind of initiated the not really outperformance, the underperformance for Tesla compared to the rest of the stocks in the stock market, and that's going to be an investigation about steering, power steering especially. So this is from the U.S. Department of Transportation's National Highway Traffic Safety Administration, or NHTSTA, as some people call it. So it was open last month, and it was just released as far as a public release today. And as you're seeing here, it's going to be based on loss of steering control frequently accompanied by driver-facing messages indicating that power steering assist is reduced or disabled. This is for the Model 3 and Y for this year's body style, 2023. It further goes on to say, a preliminary evaluation has been opened. The Office of Defects Investigation, ODI, is opening a preliminary evaluation on the 2023 model year Tesla Model 3 and Model Y vehicles due to reports of the inability to steer the vehicle and loss of power steering. ODI has received 12 complaints alleging loss of steering control and power steering in 2023 Model 3 and Model Y vehicles. Five reports indicate an inability to steer the vehicle at all. 7 additional reports cite loss of power steering resulting in increased effort to control the vehicle. A PE has been opened to assess the scope, frequency, manufacturing processes, and severity associated with this condition. So that's basically the whole report. This could be nothing. This could be just the inability to drive, or this could be a real problem that Tesla needs to fix. And there's always going to be costs associated with that. There's going to be a hit to the reception of the brand itself as well. So I'm not necessarily surprised of a slight overreaction to the market, from the market to the stock. And anyways, there's a lot of downward pressure on the stock, regardless of this at all. Like, even if this report didn't come out, I wouldn't be surprised if Tesla was down 2% today, as the markets were red from the get-go. So the next little bit of news that just came out in the after hours, I was on Twitter and I came across one of the FinTwit guys, and they posted this. United States credit rating has been downgraded to AA plus from AAA by Fitch due to the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance. Now, what does that mean exactly? Well, what could happen? Well, let's see. I think there's a CNBC article first. Okay, so Fitch, this is from CNBC. And this is breaking news for them. Fitch Ratings downgraded the U.S. long-term foreign currency issuer default rating to AA plus from AAA. And back in May, and you probably know this from the whole debt ceiling crisis, Fitch was warning the country, like, hey guys, you're on negative watch. We're going to possibly, downgrade your rating, even if you were to pass a debt ceiling resolution. And now they didn't pass one, but now they went on to say, today, in Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. So what they're saying is, you guys passed this resolution, but basically you have no debt cap until January of 2025. So you're going to spend however you want to spend. And where does this money come? How do you pay your debts back when the interest rate on the debt you're paying right now, like if you were to issue, and they're going to issue a lot of new bills and bonds, and especially bonds tomorrow, I think that's going to be the auction for the bonds. They're going to be issuing like $100 billion in debt that they're going to pay 4.3% on perhaps, or 4 who knows what the yields are going to be tomorrow, right? This news came out right before the auction. Okay, the auctions are going to start this week, and they're going to, what are yields going to look like? And the government's going to be kind of caught off foot, having to pay out so much more in interest. Like, I think the interest expense on the U.S. government's debt is somewhere in the range of $1 trillion a year, because these rate increases from the Fed funds rate increases are really making it pricey. So if there's any motivation to get these rates down, it's going to be the fact that we cannot look, $1 trillion is more than our defense budget. If everyone laughs at our defense budget in America, in the world, America spends all their money on the military, and they're not even, like, look at San Francisco, look at their cities, they're falling apart. And then now we have to maintain our debt, we're paying $1 trillion a year due to a 5.5% Fed funds rate. Now, what does this mean for the market? Well, there's an article here at as.com. What could happen if credit bureaus lower the U.S.'s rating? In short, nothing good. And highlighted higher borrowing costs for the government. We just talked about that, how they're going to have to be paying more for any debt they issue, because people are going to want a premium for taking on debt for an organization or a government that just got downgraded by Fitch. Rating downgrades would create turbulence in financial markets as well. Inevitably, this erodes investor confidence in the country's ability to pay its debts. Exports become more expensive as the dollar weakens. Now, this could have this particular thing. And we saw the dollar weaken today, as well as the yen jumped up a lot, because this whole yield control thing was just must have been a prank, because they were buying a bunch of your Japanese bonds this morning. So the dollar weakens. What does that mean? It means that if you're an international company like Tesla would be, when you're selling cars overseas, you're not losing money when you're bringing it back into America, because foreign currency would be stronger than it was last year. So it's going to have like a dollar tailwind that you're hearing companies talk about during their earnings reports this quarter. A credit rating downgrade can have broader economic implications. It can undermine business and consumer confidence, leading to reduced investment, spending, and economic growth. The uncertainty created by the downgrade may also discourage foreign investors and dampen economic activity. Now, that part maybe I think it would be really difficult to discourage foreign investors where people just don't have any confidence that the economy that they're in right now is all that much better than America's in the first place. I mean, look at parts of Europe who are very much in a recession and have 3 times as much inflation as we do. Yeah, I mean, I don't know if you really want to keep your money over there in other markets. And this happened in 2011, where people were kind of balancing this idea, okay, that so basically in 2011 in August, our country was downgraded by the S&P Global, and to the same rating as AA+. So the market was selling off pretty hard upon that news, and I'll show you that in a couple seconds when we bring up the chart. So let's switch to the charts now, and we'll take a look at the S&P 500 during the downgrade in 2011, and so we'll switch over there. So this is a SPY, and now this is a daily chart. So this is the day. So the first things first is that on July 14th in 2011, I'll draw a little crude circle so you can understand where I'm looking at. So July 14th, right there, the S&P Global had a negative watch placed on the U.S. debt. Kind of what happened with us with Fitch during the debt ceiling crisis. So from the open to the close on that day, it was kind of a 1.76% drop in the S&P 500. Now, as you probably saw thereafter, it constantly sold off after trying to regain itself. It kind of did a double top, and it sold off completely. Now, firstly, this is not where I'm marking, is not where the downgrade occurred, but I will just to give you a rough estimation of what happened over the next basically 2.5 weeks. The market dropped 18%. So it was on the 14th of August where the rating downgrade occurred. So here's the 14th, and the sell-off was, and this is if you want to just kind of count the following Monday as the total sell-off or the digestion of that news. After the downgrade, it dropped a further 8.24% from the Friday open to the Monday close. The next day, on Tuesday, it kind of sold off, even more actually, but it closed positive that day for kind of an interesting recovery of 6.6%. But at the same time, if you're looking at the chart, it kind of consolidated for a very, very long time. It rejected off the bottom of the range back here in October, and you didn't really see new highs until January. So it took about 6 months to get out of that, and the consolidation was rather large, pretty volatile considering. Now, there was a lot of other economic things going on in the world at that time. The European debt crisis actually kept the bond yields lower than what people expected, because people in Europe, they were fleeing to the US as far as a safe haven. And so the bond yields weren't all that crazy considering what happened to their downgrade from S&P. So let's take a look at bond yields now. So the downgrade is really addressing long-term debt. But this is a US 20-year. If you trade the TLT, or if anyone talks about long bonds, they trade the TLT. And the TLT has been looking pretty bad. So the TLT would be inverse of the 20 yield chart. It's the value of the bonds. And unfortunately, as the yields are going up, TLT will go down. Now you're seeing a 1 hour chart on the 20-year bond. You're also seeing how it kind of peaked above this, which could be established as a upper bound to a range, which was 4.3%. We peaked above it, and we're bull flagging right now. So as you can see in that last candle, that was when the news came out for today's downgrade. And this is your very typical bull flag. Where can this yield go? What happens to this yield? Well, could we see the highs of last fall, which was 4.6%, which marked the bottom of the market, basically. So when stocks started rebounding, it was in October, and this was the peak in yields in October. How long will it take to get there? If the yields do go up, who knows? It could be very, very quickly, very, very quickly. And how long will it stay there is a question. Peak yield is fine. The question is, how long do yields stay where they are? Now, 4.6% on a long yield, on a long bond could be very lucrative for some more conservative folks. So there might be interest there. Again, our interest rates are going up and staying up, as Powell said during the FOMC. So it makes sense that yields will go up because there's no certainty when the rate hikes will end, and there's no certainty when the rate cuts will begin. So that's the macroeconomic news. I'll switch back to the browser just for one quick other note, and just so you can see the implications of this, the timing of this rate hike. This downgrade is that tomorrow on Wednesday, $102 billion in Treasury bond sales will begin, and we hope that where the money comes from to pay for these bonds will come from their reverse repo, which has been the case. It's been tracking the general treasury account pretty well. So it's not really taking liquidity out of the market to buy all of these hundreds of billions of dollars in bonds so far. Okay, back to the chart. Let's look at Tesla. Tesla has not been very good to us lately. And as you can see here in the dotted blue line, which represents the after hours trading at this time at 3:39 p.m. on August 1st, 2023, it sold off, what is that, $1.50 so far? No, $2.50 maybe so far in the after hours, so not a great look. Now, we were talking about the idea that this Tesla reaccumulating, meaning would Tesla be kind of basing here, forming a local bottom in its price action and accumulating interest and moving upwards to try to make equal high or new high based off the earnings of, let's say, Apple or Amazon coming in very well. That still could be the case where the whole market is lifted because the big mega caps are generally doing okay better than what other people would have thought. But at the same time, Tesla could definitely diverge from the market because of sentiment, because of lack of clarity in the prospects of profits, the margins for their cars. We don't have any idea when these new models are going to be released. Manufacturing hasn't started on the next generation vehicle as of yet. And we're also facing just the economic headwinds of high interest rates for a pricey product in relative terms to, let's say, your general everyday spending. Cars are very expensive, the second biggest purchase you'll ever make. So there is a lot going against Tesla, even though it is a market sector leader. It controls basically all the EV sales across the globe. It outsells some of the long reigning sales champions in the car world, even when you're considering ICE vehicles, which is like the Toyota Camry, Toyota Corolla, Toyota RAV4. It's outselling the very much staples of the market at even a slightly higher price point, considering that the EV vehicles would be more expensive than your average Corolla. So there is some good news to the fact that there is a lot of people that are interested in having Teslas, regardless of the economy. Like 5.5% interest rates, but it's paying cash. And I know a lot of people can't do that. I couldn't do that if I wanted to do that. I couldn't do that. But it does say something that there is some positives there, that there is just this natural desire to have a Tesla, to the point where we don't spend money on advertising like other companies do. Other car companies spend billions of dollars a year, and Tesla's $150,000 for last year. But anyways, let's look at the chart here. So it's almost to the point where this could be an invalidated idea that we're not really showing the want to go up, meaning that there is just not enough buyers who can prop this price up, considering everything that's going on in the world of Tesla. And you could say that there's some distractions for Elon when it comes to the X and Twitter situation, even though he has a new CEO. But regardless of that, it doesn't even, like, who cares about that? It's just that the stock should perform based on the company, how it's doing. It's selling the most EVs in the world, but it doesn't matter to a lot of people. With low institutional ownership of the stock, what's going to keep it up? Is there enough retail money out there to work together to keep the price up? Obviously not. I mean, the way Tesla sells off over the course of the last couple of days, there is no buyers. There is very, very little interest. There's no buying, like institutional buying. It's hard to replace it because you're just vulnerable to these very volatile moves. But let's go to the minute time frame first. Let's look at Tesla's price action. Okay, let's take a look at August opening. So here's the opening. It was a gap down that continued to sell down. So it gapped down $1, and it had no buying at all at the open. So it sold off another 1%, which was $2.50, and did a slight retrace. And after the retrace, it sold off another percent. And then by the end of the day, from that point on, it was another 0.5% sell-off after this long ranging. And of course, now the price of the stock is, as you can see here on the chart after hours, $258.78. Now, the rest of the market was pretty flat. It wasn't like the market was doing anything exceptional. There was a gap down in the Qs. It was completely flat the entire day. It never went green. How about the Dow? The Dow had a slight little bounce in the morning and stayed flat basically the rest of the day. But as you can see, on the indices, they're also selling off in the after hours from the news of the rating downgrade from Fitch. So this is all in line, and Tesla is just selling off more because it's a high beta. But yeah, there's nothing great about this price action. It shows that there just isn't any interest to own the stock. The volume is very, very low. Like there's nothing going on at all. All right, let's look at the chart again and talk about we were talking yesterday about a pattern of accumulation that maybe the price will go up. But like I mentioned in the beginning of this video, there's real no sign that it's actually going up. It's not making any highs, just making lows. And we drew this darker orange line to kind of show what would happen if there was something called a distribution or a redistribution of the stock. Now, I call it redistribution because it's sold off already. So when something distributes, it's creating a pattern that will sell off, meaning that it will fall after that pattern completes. And I have two images here on the screen. First of them is the redistribution schematic from the Wyckoff kind of theory. And we talked about how, I'll bring it center, you can kind of compare to this local area ever since the earnings sell-off, where it kind of looks like that pattern, kind of. And where it starts to diverge from what accumulation is right around here, where it should start going up. It shouldn't try to, so basically if this makes a low, if this goes down to $255, you can basically say that redistribution is happening instead of the accumulation of that lighter yellow line that's going up. If it makes an equal low, you'll see a struggle to kind of keep it at that $256 point. And it'll maybe float around there for a couple seconds. Then if it wants to sell, it'll sell off pretty violently. We talked about where it would stop, probably somewhere in the gap that's been left behind, anywhere from the 240 to 234 area. And after that, maybe down to 226, maybe somewhere around here, where there's a little bit of interest. And it kind of lines up with some volume from many months ago. But as you know, when Tesla sells off, it sells off pretty violently. If we want to just remind ourselves about what sell-offs look like, they don't really stop for a good while. Drawdowns can be pretty severe, 37%, let's say. How about this one? 46%. What about this one? And these are from the all-time highs, 37%. So basically anywhere from 29 to 40%. If we were to track the drop so far from the earnings, from the peak right before earnings were released, we have fallen 13%. What does 28% look like from the all-time high drop? 28% would put you at $214. And that was just a conservative drop for Tesla because the all-time high drop was not even the biggest one. What is 35%, let's say? 35% puts you in this area of interest. It'd be $194 a share. So right now, things don't look too great. What is some more evidence that we're in a distribution phase of Tesla? Meaning, like I mentioned yesterday, distributing means their shares are being controlled sell-offs, meaning that the market doesn't want to just dump all the shares onto the open market because it wants to get the best price it can for it. So it's going to, slowly sell every now and then over the course of many days. And that could be what's happening. There is not much people that are interested in buying, so volume stays low because they cannot find buyers at the price they want to sell at. They don't want to sell at any price. They want to sell at the best price they can. So they're trying to sell in very controlled spurts. And what does that look like exactly? Well, it looks like every time there's a peak, it just sells off. So basically, the price moves up a little bit, it sells off. Price moves up, it sells off because they're trying to get the best price. And they figure 262 is the best price currently that they can get. And maybe they are right because they wouldn't be surprised if tomorrow we open up in the 250s. Now, here's a pattern. Instead of redistribution, it's the distribution phase of the Wyckoff theory where a topping pattern is created. And you can kind of see it looking at this schematic here that you have this initial high off a rally. It's sold off, creates a peak that you're seeing here, and creates couple more peaks, and then it creates something called an upper thrust, meaning this is the highest point in the pattern, and it's quickly sold off. When the thrust happens, it peaks above a range, which I would say was around $280 a share. It peaks above it, sells off, and another major high is not created. And you can kind of see that right now, how there's no other highs that are better than the gap down high from the earnings. They're actually lower highs. You could say that there's higher lows for now, but that doesn't really matter. As you can see in the pattern, higher lows are a thing. As pricing struggles to maintain itself and keep itself afloat, you'll see price start to drop really very quickly over the next couple of days, possibly 4 or 5 days. You can see dramatic drops in price if this distribution plays out. So that's the distribution and redistribution. So on a bigger time frame, the time frame from the beginning of the range in June till now, as you can see, we've gone really nowhere. We've talked about this a lot, where Tesla likes to do these rangy moves for very long periods of time. Let's say the move will be over by the end of the week. This would be a 55-day consolidation, a 55-day range of 24%. That would actually be a pretty average range before a big move down to the downside or the upside would occur. We don't know which. Right now, it looks very bearish, just because you see it yourself. If you're tracking the stock, no one's buying the stock. There's other things to buy. There's other short squeezes that people are interested in, but those short squeezes, they last a very short period of time until all the shorts are covered, and then the price will free fall by itself thereafter. Then again, we don't know how long the short squeeze will last. And these are names like the Carvanas, the Upstarts, AMC and GameStop were the originals in the meme stonk era. So I'm not saying I'm super bearish, but currently there's no reason to be too bullish. But this is what we're looking at so far. Now, I mentioned that we had a 55-day ranging since we've gapped up back on June 8th. Just to refresh people's memories, if they haven't been watching my videos, we like to say that Tesla has strong moves and consolidates for very long periods of time. This is a 32% range from the high to the low. This took 83 days. This one, before Twitter was purchased, if you want to say it's somewhere like this, as far as the range, this was 71 days, and it was a 20%-ish range. Maybe a little bit more if you count from the gap up to the opening gap down, 23%. So that's not all that different from our current range. So Tesla likes to do these consolidations right now. It's trying to figure itself out. And how long could Tesla range for? Well, it wouldn't make sense for it to range much, much longer. It's going to make a move soon because the catalysts kind of line up for it, with Friday being the reaction to Apple and Amazon's earnings and non-farm payroll, the jobs report coming out that morning. So Apple and Amazon report after hours on Thursday, so you'll have a reaction in the after hours. And then during the cash hours on Friday, you'll kind of have a digested move when people are thinking about what they need to do. Apple is going to report very, very low numbers compared to, year over year. The market understands that, so it's not like that's a huge surprise, but just something to think about that, just to prepare yourself. And how to prepare ourselves. We've been talking about selling covered calls for every single video, basically, because we've identified the type of price action Tesla gets itself into, which are these long ranges. If you would have sold a covered call here in June 8th, even if you would have sold one for $280 at that point, yeah, you might have got scared around the earnings time. But if it was a long dated 2 months out, you would have been totally fine so far. And you would have been making money with the premium being burnt off due to the time that is elapsing from the time you sold your option. So selling options is a good way to kind of cushion yourself against any sell-offs. It's a way to create a way to make income for yourself based off your investments, and it gives you capital to do other things with it. We talked about how if you are identifying yourself in a certain type of trend, you don't know when the trend is going to end. So a lot of people that bought around, the $150 price, or perhaps back in January at the $100 price for Tesla. And they were very shocked at how fast Tesla moves upwards in a very short period of time. It was very, very, very quick. And they were thinking like, okay, around here at $291, I'll sell a covered call against my shares, only to find out within 4 or 5 days, the price has gone up by $14 a share. And the shares were called away because it was such a short period of time. Maybe a short dated call was sold, and the stock moved very violently after this little flagging action here, which could have looked like a bear flag to a lot of people. And so they would have been right for a couple of days, and then they get all their shares taken away just 2 days after that flagging. So we said that selling calls, we don't want to get our shares taken away necessarily, but it's very, very possible that it could happen. So just a word of warning: when you sell covered calls, you're using your either money, cash, or your own shares as collateral for that call. They will be held, and you cannot really play with them. You can't sell them until you get rid of your call by closing it out, which could mean closing out in the profit or closing out at a loss as well. Now, that's the dilemma that people have, is that, okay, if I sell a covered call against my shares and this price goes up to that strike and I'm at risk of having my shares taken away. Number one, if the strike price of the Tesla is just slightly above the strike you sold your option for, you're really not at a loss because you collected premium upon selling that call, and then of course the shares will be taken away from you near that strike price. Now it becomes more problematic when the strike price of, let's say, 280 and the shares of Tesla are at 290. You're losing a $10 difference per share because you sold a covered call. And if the covered call wasn't a $1,000 covered call, you're not making up that $10 a share. You're selling at a technical kind of loss per se. So that might make you feel bad. But there are some ways to kind of get around that. So you need to firstly identify if you're in a trend at all. If you're selling calls around here, you could do that pretty safely by having a slightly longer dated call and then buying a call yourself in something that's called a calendar spread, a type of options trade. Now, we can't really say on a longer time frame that we're in any type of trend. Sideways is a trend, but if we're sideways, in which we are, as you can see, we're at the same pricing as it was back in 1.5 months ago in June. That if you're in a sideways trend, you don't necessarily need to buy a call, which would be your insurance. Okay, if you buy a call after selling a call, you're buying insurance for some type of upside risk. Okay. Now, what you want to do is, instead, if there's no trend to be found, you can buy insurance for yourself if there's catalysts that could work in Tesla's favor. For example, let's say Apple and Amazon's earnings go very, very well. Maybe the whole market is lifted because, number one, all of earnings season would be basically over, and every company did pretty decently compared to expectations. Maybe not so great compared to last year, but great in comparison to the analysts' expectations for the performance of their companies. That you could use that scenario along with non-farm payrolls as a potential upside risk that you'd want to buy insurance on with a call of your own. So let's take a look at that. Let's go to the browser and we'll go to our trusty little site. And that's going to be the very easy to use optionsprofitcalculator.com. And you can click on calendar spread under spreads on the top, and it'll give you the opportunity to kind of play around with the numbers and see what type of protection you can get. Now, first things first, you need to have a call that you kind of you need to pinpoint how much of your premium that you'll collect from your sold call, which would be over here, how much would you want to use of that sold call to buy insurance for that upside risk I'm talking about. So first things first, we're going to say that you want to sell a call that's more expensive, and you can get more premium by further dating your call, meaning having it further out, Currently, this is about 3.5 weeks for this call that I would sell. This is just an example, guys, not financial advice. Okay, this is just an example of what can be done to hedge a little bit of any downside. So selling this call against 100 shares would net you $818 approximately if you're to do it today, not tomorrow, because obviously the price of Tesla has gone down a little bit. So you get $818 of downside protection. So if Tesla's price of the stock price does not go above $270 by August 25th, you collect $818 free and clear, meaning that if Tesla closed at $261 today, you would actually break even if Tesla closed at $254, $253. So if Tesla closes at $253, 2.5 weeks from now, you actually would have broken even because you sold this call. And heck, if Tesla goes down to $240 a share, you still save yourself $818 per batch of 100 shares, basically $8 a share. So instead of losing $2,100, you would have lost instead $1,200 ish dollars. So you basically reduce your loss by 40%? That's not too bad in that specific scenario. Can Tesla go lower? Sure, it can go lower. We understand that. So if you wanted to buy upside insurance, how much would you, of that $818, how much would you want to spend to buy that insurance for the upside? Now, I have to say first that I'm just using a scenario where I'm buying the call for my insurance the same day I'm selling the call to protect my downside, right? It doesn't always have to be like that, firstly. What you can do is, when Tesla's green for the day, that's kind of when you want to sell a call. When Tesla's going up, the call, of course, would be the premium you get for your call would just be more expensive because Tesla's going up. If Tesla was red for the day, of course, the call would be less than it was when the day opened. But so let's say you would sell the call on some random green. Maybe let's say, for example, tomorrow Tesla actually does open and end green, and you can sell a 270 call for more money than what you're seeing here on the screen. And as far as buying insurance, sometimes you don't want to buy insurance the same day. It just kind of leaves you open to maybe overpaying for that insurance. Let's say tomorrow Tesla is green, but on Thursday it's red. Well, firstly, the call you can buy will be cheaper, correct? So it wouldn't be $161. It would maybe be $130. So it gives you some flexibility of when to enter for a little bit of insurance to the upside. But this is just a quick example, a quick dirt example of what the insurance can do for you. Okay, so what does it do for us? So as we know, you want to buy the insurance on a shorter dated, similar strike. So you want a shorter date because, of course, the volatility would be higher. And that means you have a potential of getting some profits from that call that will help you close out the sold call so you can actually keep your shares if, worst comes to worst. Now, what is the scenario that looks like? So this slide kind of gives you the ability to calculate the exit of your particular strategy. So let's say we were to sell that call today, and we bought the insurance today as well. And these are the strikes and the prices right here. And you can click on a day, and let's just say in this kind of matrix that we want to close Tesla on Friday because it got to $280 a share. And that means that would have been a 7.28% move over the next 3 days. And that also, what that means is that now Tesla's $280 value is in the money for the call that you sold, which was, as you can see here, you sold a call with a strike for $270. So if Tesla has upward momentum, you could get your shares called out for $270, and who knows what Tesla would be at August 25th price. Maybe it would be $300. So not only do you get your shares taken away, but you lose $30 a share in that hypothetical scenario. So in this matrix, you can click on a box and it brings up a little window that gives you the calculation of what it costs to close both calls out, meaning exiting the trade completely and then freeing up your 100 shares per spread. So if Tesla got to $280 a share, which is 7.28% move on Friday, the value of the call you sold goes to $1,762. $1,700. Remember, you got paid $818 for it. So it more than doubled. It went up like 100 something percent. Now, if you didn't have any upside insurance, if you wanted to close out this call, are you going to pay $1,700 to protect your shares? I'm not sure you would, because you don't know if the stock price would drop on the Monday after that. Maybe on the 7th of August, that Tesla will go down 10%, and you won't have to worry about closing out your call. But it also can go up. What if the momentum is so strong from the release of the Apple's and Amazon's earnings and non-farm payrolls came in very, very cold, meaning that not many jobs are added? That would mean that potentially the interest rate cuts for the Fed funds rate could happen a lot sooner, which is very, very bullish for any type of stock. And you wanted to close out your spread and not risk losing your shares some 2 weeks later. So we know that the call you sold became $1,762, but the call you bought went up to $613. And what does that mean? Well, that call cost you $161. So we're talking about what, a 400% increase in price? So you can see how a shorter dated call would be a little bit more volatile, giving you more premium for that type of move in the shorter term. And entry and exits, like I have to say, it's really important when you buy this insurance, and also when you sell your call, you're really going to need to try to get the most of your money, buying on a red day for the call and selling a call on a green day if you can. Sometimes you can't help it though. Sometimes you just can't, you have to, if you need that downside insurance, you just got to do what you got to do. Okay. So we know that it cost us $1,762 to close out the sold call. We can sell our bought call for $613, and the loss to preserve your shares would be $492 to close out that trade. So instead of losing your shares potentially down the line, maybe Tesla goes up to $350 a share, and you're sitting on a call that you sold at $270 a share. This gives you the opportunity to get out of the trade if you want to, because Tesla went up $19 a share in this hypothetical scenario to $280 on the Friday. It's only a 7% move, by the way. We've had 7% moves intraday, so it's not like it can't happen. But so that's $1,900 for every batch, $1,900 for every batch of 100 shares. So you can close out that trade for 1/4 of the price of the gain in the value of 100 shares, which was $1,900. You can close it out for $492 if you wanted to. Now, what you can also do is just kind of keep tabs on this and just sell your call that you bought for profit. So for the $282 call that's expiring on the 11th, if you get a good move by the end of this week, you can close it out for your $613 and just keep it. And just kind of keep a mental note, like, okay, I generated $613, but in my mind, and this is on your own research, you're telling yourself, I think Tesla's going to come back down now, okay? So I don't have to close out my call just yet, right? I can just go ahead and sell the call, keep my profit, and maybe on Monday, when Tesla goes down, if it goes down on Monday for some particular reason, or Tuesday or Wednesday or Thursday, basically any day until the 25th, I can close out the call, okay, for a cheaper price. Now, that's one way to handle it, where you're being a little bit more active and a little bit more dynamic with how you're handling that particular transaction. Now, is there there's another way to handle this as well? Maybe you don't want to be out the $492 to close out the trade, because in your mind, I'm like, that's a lot of money. It is a lot of money, but you're also preserving your $1,900 in value at that very moment in time. But how do you, okay, so you have that $1,900 in value, but how do you leverage that? How do you leverage it again? Well, what I would do, and this is not what I want you guys to do, is I would actually go ahead and sell another call again. So let's say it's Friday and I close out this trade for $492. Well, I don't want to be at $492. And plus I want a little bit more downside protection again, but not at the risk of selling my calls. I'm selling my shares at $20, $30 less than market value. So what I can do is let me close out the Bloomberg video here. After I close out that particular transaction, I can just go ahead and sell another call. And these prices obviously don't reflect the value of what that call price would be, but you can just select another call and say, look, I want to sell a call that'll get me $200. And so you can just sell another call immediately and have a little bit more downside protection after a big move. Okay. And then if it's a lower price call, let's say maybe 50% of the loss, let's say you want to sell one for like $250, right? That's a little bit more manageable as well to close out with any upside insurance. And if Tesla goes red over the next couple of days, that's just your ability to either close out the new call you sold or buy insurance for the upside. Maybe a very cheap call that would expire sometime the week after of the current week you're in. So you don't have to be a victim to your covered calls. You just have to manage them a little bit. I know we don't all have a lot of time to, watch pricing all day and get the best entry. And I don't either. I don't have the best entries on these things. What I'm looking for is that we've been talking a lot about how the movement and price action for Tesla stock has not been very, very bullish. And we've been talking about since the beginning of January of how to protect the downside. And we've been talking about that because once again, we have consolidated. We've talked about this over and over again. It is the reality. It played out exactly as we thought it would play out. We haven't gone anywhere, and it's been 2 months, which is very, very normal. So instead of just sitting on your shares, if you're being conscious and being honest with yourself, we can all be hyper bulls about Tesla all we want to, but it doesn't mean the price action will support your theory that, let's say, that Optimus robot is going to be $1 trillion industry, or that every single OEM legacy auto manufacturer will sign up and license FSD and cameras from Tesla and become another $1 trillion SaaS-like industry. No, we don't have to be. You can just be honest with yourself and say, Tesla moves in these very violent but constrained ranges that last months before another move in a large way up or down will occur. And as long as we can identify the trend up, sideways, or down, we can kind of work a cover call strategy into that in a way that keeps you protected from a little bit of downside, but also gives you some tools to understand how you can limit the risk to the upside, having your shares called away from you. Well, thanks so much for listening, guys. That's all for today. Let's hope that the ratings downgrade doesn't have a huge effect. Actually, let's look at the market. It's 1 hour to close of after hours trading. Let's take a look at where Tesla is now. So Tesla rebounded a little bit, $259.30 in the after hours from the 258.40 perhaps. Let's look at the NASDAQ to see. NASDAQ did not rebound. So NASDAQ is down. Now here's, you can give a look at NVIDIA. NVIDIA is down $3 a share. The Dow is down on the DIA $1. How's the S&P 500? S&P 500 kind of had this really sharp sell-off during the release of the news after 6. It kind of bounced back a little bit and moved up 0.25% after gapping down 0.5%. We talked about how the 2011 had a pretty sharp sell-off. Just know that the context of that sell-off is a little bit different from what we're going through right now. So maybe there won't be a really, correlated comparison. But just be on your toes for tomorrow, guys. and keep in mind ways to hedge your Tesla investment. Thanks so much. Bye.